We have reached a framework to implement the Geneva Consensus and the call between the two presidents.
Trade once again dominating headlines today. We're half an hour from the opens in Hong Kong, Shenzhen, and Shanghai. I'm Yvonne Man. You're watching a special edition of the China Show. We're bringing it to you live from Bloomberg Invest Hong Kong. The top stories this morning, the U.S. and China moving to ease tensions with a new plan to implement the Geneva deal, now heading for approval from Presidents Trump and Xi. Markets reacting cautiously with few concrete details out of the London talks so far, but the U.S. side says it expects issues around rare earth minerals will be resolved. Meanwhile, we'll get reaction from our big-name guests here at Bloomberg Invest Hong Kong, including the city's finance secretary, Paul Chan, joining us live in just a moment. All right, taking a quick market action here right now, and we want to welcome, of course, our viewers and our live audience here at Bloomberg Invest Hong Kong. What the market and state of play is right now, it seems like equity markets are really liking the sentiment around what happened in London, right? So consensus seems to be the buzzword that came out near Buckingham Palace here from the U.S. and China delegation here. But look at U.S. futures, look at China futures, still in the red. So the devil is in the details of what really was agreed upon on day 2 of these talks. But you look across the region here, we're talking about Asian stocks continuing to like the news that at least the sentiment is optimistic, right? You take a look at what we're seeing on your Asia regional gauge. We're nearing the levels that we saw back in 2021. Kospi's up for a 6th straight day and really leading the charge here right now. Futures in China, though, are slightly to the positive side. We talk about the bull markets in Hong Kong, right? Lots to talk to Paul Chan about, the financial secretary, in just a few minutes. He's going to be joining David on stage any second now. Dave, certainly it's been very interesting, right? That the U.S. and China and these simmering tensions in some ways has benefited Hong Kong, right? We're talking about bull markets in Hong Kong. The IPO market certainly is making a comeback with a lot of Chinese firms making secondary listings here in the city.
As well as a rising technology and innovation hub, we concentrate on these 3 fronts to move forward to drive our economy to continue to grow.
What are your expectations for the economy this and next year?
This year, the estimate GDP growth is 2 to 3%, as indicated in the budget. The first quarter performance was impressive, 3.1% growth. Export strong, private consumption a little weak comparatively. Given the changing spending patterns of Hong Kong residents and incoming visitors. This is understandable, and we help the industry to transform, to reinvent themselves to respond to this change. This will take a little time. Investment also sustained. Into April and May, the figures currently available, exports still holding up. Investment still quite good. Stock market is doing quite well, and the pipeline is strong. So we expect this year the stock market will continue to be strong, and this will give support even to private consumption.
Right. The wealth effect, as they say, in fact, quite timely. It's almost like we planned it yesterday at the close. The Hong Kong stock market, specifically the Hang Seng China Enterprises Index, actually entered a bull market as of the close yesterday. It's almost like we planned it. We'll just say we planned it. We'll just say we planned it. On the market side of things, one of the big highlights this year has been the return of big listings in Hong Kong. We have had a massive one, CATL, a few weeks ago. Just give us a sense of what's in the pipeline.
Well, CATL is a classic example, drawing a lot of attention. And also, the deep-sea moment, causing the foreign investors to reassess, number one, the technical capabilities and innovations on the mainland and the possible investment options. Number two, people find that perhaps earlier on, last year, say, for example, they had underweight their allocation to this part of the world. So you saw funds flooding in. We have looked at the IPO pipeline, very strong. On the one hand, given the geopolitics, it is getting more difficult for tech stocks, say for example, to go to the US for listing. Then if they sit for international listing, Hong Kong is natural destination. And also, as you mentioned, the return of the China concept stocks. I've already asked my colleagues in the Securities and Futures Commission and the Stock Exchange to get well prepared for them to come back to facilitate this listing.
Should we expect more big listings this year?
More to come, actually, more to come. The pipeline is very strong, and also the central authorities are very supportive of this move, encouraging the mainland major companies coming to Hong Kong for listing.
For, I guess, those who, I cover the story every day, and almost every day it still surprises me that big name after big name either files an application or gets approved from for an application. If you could give maybe some in the audience who might not be too familiar, why are we here? Why are central authorities encouraging more listings to come to Hong Kong? What's the background?
Well, you know, number one, for China's development strategy, they talk about domestic circulation, meaning stimulate domestic consumptions, domestic consumption-driven kind of growth, given their vast market, huge population, and the aspiration for better goods and services. This is one. Number two, they are also encouraging mainland companies to go global. There is also a saying, you either go out or you are out of business. So you can see mainland companies are getting very interested to go global. And there is also commercial justifications. You talk about the capacities on the mainland, say, for example. If they're able to diversify their industry chain outside of the mainland, say, for example, in Global South, in particular Southeast Asia, that will help address certain of the capacity issue. And also, this is the rising market, very familiar with the Chinese culture and custom. And the Chinese people are doing business there for a long time. So this outbound of mainland companies, this is a trend, unstoppable. And I think this is good also for the region, because by realigning their industry chain, their supply chain, they will also stimulate the growth of the region. And Asia, as you know, particularly this part of Asia, is a major global engine for growth. And given the Chinese economy growing steadily on a sustained basis, also become a stabilizer in terms of the current, sometimes pretty uncertain and volatile global market.
Stephen Roach, former, and there's a smile already because for those of you who might have seen it, had a very, Stephen Roach, the former chairman of Morgan Stanley Asia, I think it was June of last year, made this fairly bold call that they said Hong Kong was over. A few weeks ago, in fact, about a week and a half ago, he somewhat changed his tune and said it's too early to call Hong Kong being over. In fact, he came on the show and explained why he had a change of, somewhat of a change of mind. And one of the things he said was he didn't expect Hong Kong to benefit from a listing standpoint, to benefit from this rift that's taking place between China and the US. Is that, would you agree that Hong Kong has somewhat benefited from what's all the uncertainty out there?
Well, you know, Hong Kong people are very agile and very adaptive to changes. I think the circumstances are bound to change, both external, on the global front, often also in this region. The question for us is to try to identify the mega trends. Say, for example, currently it is the geopolitics, the green transition, the digital economy, and then redefine ourselves, get our positioning right, and concentrate to do the right thing, and leverage on our uniqueness and the competitive advantage. I think our uniqueness and competitive advantage is under the one country, two system. Hong Kong is still the platform for the mainland to interact with the international investors. I think our opportunities is not just financial services. Say, for example, talents, the return of overseas Chinese talents, the coming of international expatriate talents. Hong Kong has been attracting a lot. Since we launched the scheme to attract talents at the end of December 2022. Up till now, we received over 460,000 applications. We approved 213,000 of them, and about 118,000 already arrived. And they are more coming. That is one. And also technology, artificial intelligence, for example. For artificial intelligence companies on the mainland, if they want to go global, well, they need data. They need because for the AI industry, this is core. Where can they get the international data? It is Hong Kong. For biotech companies, for drug development companies, if they are interested, say for example, European or American drug companies, if they are interested in the mainland market, where can they get the biosamples? Where can they do the clinical trials? Where can they do the expedited drug and medical device registrations and get those to be sold on the mainland and at the same time overseas? Hong Kong is the answer because, for example, we have the approval with the central authority in the Lok Ma Chau route on the border of Hong Kong and Shenzhen. We will set up those facilities, and the mainland regulatory authorities will set up a branch approval authority there to expedite the approval process. So the opportunities, I think, is tremendous. It is how we position ourselves and how are we trying to gather the critical success factor together in Hong Kong.
You know, that's a very good point you bring up. The three industries that immediately come to mind when I think about Hong Kong is finance, legal, and property. In a couple of years' time, to your point, some of the structural shifts, what do you think will be the dominant industries and sectors in Hong Kong, given the mega trends that you just outlined?
I think going forward, well, although, as you know, in the 14th five-year plan, we are given 8 centers status. These are the development directions. But to me, I think the key drivers would be financial services, trading, technology, and innovation. These are the 3 drivers in terms of contribution to the GDP. Although the innovation and technology sector will take some time, but interestingly, these few sectors are interrelated. If we want to be successful in the technology sector, our selling point, apart from the international dimension, the availability of international talent and data, is our full range of funding options for tech companies. No matter you are a startup or at different stages of development, you need angel investors or VCs, or you want to go IPO and then to do the subsequent round of funding. Hong Kong offers this full range. And this is operating on common law. We practice 3 spoken language, 2 written, including Chinese language. And this is an environment very familiar and trusted, both by international investors and our mainland counterparts.
I just thought about the other point that Stephen Roach brought up in our interview we did about a week ago. He said, you know, when you look at the number of listings in Hong Kong, or at least the list of listings, the dominant theme is these are mainland companies listed here.
True. Yeah.
Does Hong Kong need to do more to attract non-mainland companies? Is Hong Kong open to companies from all over, including the United States, to list and raise money here?
Yeah, the current situation is natural. Because we are part of China, mainland companies are rising so fast, they want to go global. But we do want to attract more companies from overseas to come to Hong Kong for listing. In the recent years, as you know, the chief executive, myself, and my other policy secretaries, we travel a lot to Southeast Asia, Middle East, for example. Even went to Europe. We want them to come because this is an open platform for all. And we do believe international collaboration, leveraging to our respective competitive advantage is the answer to counter the unilateralism and to promote shared prosperity.
You mentioned the Middle East. We've been waiting for one big company that has been speculated to maybe look at, I don't need to mention the name of the company, 6 letters. Yeah. Do we eventually see a big energy Middle East energy company list in Hong Kong at some point?
There are many other good companies.
Okay.
And indeed, interestingly, even for Saudi Arabia, say for example.
I didn't mention Saudi Arabia, but okay.
Indeed, the Gulf area as a whole, what they are looking for at the moment is not just outbound investment. They are very keen also for inbound investments. And in particular, business in this region, in Hong Kong, in GBA, on the mainland, to go there to set up manufacturing facilities, to work together with them in terms of the real economy, because they also, say for example, in Saudi, they have the Saudi 2030 vision, diversification of the economic structure. And I think this is a strategy pursued by all the Gulf companies. So our collaboration with them are multi-level and multi-fund. And we are seeing more mainland companies in this region, in Shanghai, Zhejiang, Jiangsu, going there as well. And there are companies coming.
Okay. I need to ask you about, we have about 5 minutes left, about the recent weakness in the US dollar. We can talk about the peg in a moment, but I just want to get your thoughts on what are the major implications for Hong Kong of a weakening US dollar? Does that in any way change, say, the way you look to construct your reserves? And what are the other major implications that might have?
Well, Hong Kong become a safe harbor for this international capital because our dollar is pegged to the US dollar. Since 1983, it has been functioning very well. We don't have exchange control. Capital coming in, going out anytime. We ensure that is continue the case. And this is our very solemn commitment. And this is also a competitive advantage. And for us, income coming in, going out can be very abrupt, very sudden. So ensure financial security stability is number one. Number two, at the moment, well, with this influx of capital, interest rate is indeed very low. Good for our homeowners and good for business as well. So I think CBL, put the CBL on, but at the same time, take advantage of this ample liquidity.
You bring up a very good point. You know, one of the big stories, in case some of you missed it, in Hong Kong recently was the drop in HIBOR, to which a lot of mortgages are tied. You know, the drop from, I think it was north of 4 or 5%. Last I checked, we were at 0.5%. Is the preference for HIBOR to remain low?
Well, this is market behavior.
Okay.
So we won't interfere, but well, the current low interest rate is welcome.
Okay.
Yeah.
Well, let me rephrase it. Is the objective in some ways, because you have sort of control over liquidity in Hong Kong, which somewhat affects HIBOR, for example. Is the objective largely to keep HIBOR and interest rates low within the peg system, of course?
Yeah. We believe in market force. We believe in market force, and we do not want to send any signal to the market to cause any misinterpretation about the government's intervention into the peg. So we believe in the market.
And the peg stays?
Of course. No.
Well, tell us why, because a lot of people over the years have called for the peg to be rethought. Why does it not make sense to rethink the peg?
As you know, we are a small, open economy, international financial center. So it is important for us to hold to our core competitive advantage. That is open market, income, capital coming in, going out freely anytime at a stable, predictable exchange rate with predictable, transparent, and consistent government policies. This is the core. We don't want to allow any misinterpretation of this. I think we went through many cycles and ups and downs in the market since '83, the implementation of this system. It has been functioning well. At different times, different sectors of the economy may have complained, but overall, for Hong Kong, it's a good thing.
Very quickly, you oversee the budget as well. Just a final question on that. Next few years, we've had some constraints around financing because of what's been happening since 2019. We've had COVID, for example. What's the government's target in terms of balancing the budget? And just give us a sense of how you're thinking about the finances here.
Yeah, great. Thank you. We must distinguish government budget into two major components. One is operating account, daily income, expenditure. All the taxes go there except land revenue. And the other is the capital account. The major income is land related. And the capital account is for capital investment, infrastructure investments. We believe the management of these components, the philosophy is different. For the operating account, we need to seek to balance, and not just balance, to register a surplus, to give us the room to invest in more capital works, invest into the future. So this year, 25-26, the operating account will be break even. And then on, we'll register surpluses. For the capital account, as you know, we want to expedite the development of the northern metropolis, because there is where we will house the technology and innovation sector. The companies we attract, we don't want to settle them there. We want them not just use Hong Kong as an office, but set up your research, set up your manufacturing, particularly advanced manufacturing facilities there. So we needed to have the land. So for the capital account, the annual capital works expenditure will be increased from 90 billion a year to 120 billion a year in the coming 5 years. So it will be a deficit in the capital account. How do we finance this capital account deficit? Make use of the market resources. Public-private partnership is one. Issuing some bonds is two. And in terms of bond issuance, our borrowing ratio is so low. By any standard, there's room for us appropriately to issue some bonds to finance the capital works, and also consider to issue some long-tenor bonds, with 20, 30 years. So these are all the financial tools available to the government to manage our books. And in fact, the rating agencies has reaffirmed the rating of Hong Kong, also the stable prospect of Hong Kong economy, and also acknowledge that our policy making in terms of the financial area is flexible and appropriate.
Mr. Financial Secretary, we have just about a minute left. There's a live audience here. There's a live audience, global financial community watching us live. Any last final message?
To our friends from overseas, I would invite you to come to Hong Kong. A lot of events going on, arts, sports, and also come here to see how vibrant this area is. And not just Hong Kong, but also taking the opportunity to visit the Greater Bay Area. That will give you more understanding of the opportunities. Thank you.
Right on time. Thank you so much, Paul Chan, Hong Kong's Financial Secretary. Thanks. Thank you so much.
All right, we're going to leave that there, but Bloomberg subscribers can continue watching on Live Go and all the panels that are going to be happening here at Bloomberg Invest. Just go to Live Go on your terminal. In the face of all this, of course, we've been talking about what Paul Chan said, right? He's still very optimistic and seeing a strong IPO pipeline coming here in the city, and that the central government has really been encouraging a lot of firms to come and raise money here in Hong Kong. So he's still sounding quite optimistic about the outlook when it comes to Hong Kong being that financial opening and bridge to the West when it comes to all these Chinese companies. So certainly that's one thing to watch here, right? We still have to focus on what's happening when it comes to trade negotiations. So we wrapped up day 2 between the U.S. and China in London with an agreement, at least, a consensus on a framework plan which could revive the flow of sensitive goods between the world's 2 largest economies. Let's get more now with our Chief North Asia correspondent, Stephen Ingles. Steve, we're still waiting for the details, but what do we know at this point where we reached consensus?
Yeah, well, they had to bring down the temperature, obviously, and that helped with the phone call last week between President Xi and Trump because things got off track a little bit. And that is something, those are the words that Donald Trump actually used, that the trade relationship following that truce a month ago, 4 weeks ago in Geneva, kind of got off track because of differing signals from the 2 economies. Of course, the United States added more export controls on China, and China, to the White House assessment, essentially slowed down the licensing and export process of critical rare earths, which China dominates with 75% of production of rare earths, 90% of production of rare earths and those magnets that are needed for aerospace and defense industries in the United States. So things got off track, derailed a little bit. The phone call last week got the two sides essentially talking at that top level. They had 2 days of talks that just wrapped up at midnight in London, Tuesday at Lancaster House near Buckingham Palace, and both sides were speaking in similar tones. First, before Howard Lutnick and Jamieson Greer, the U.S. Trade Representative, spoke to the media, we got some comments from Li Changgang. He is the Vice Minister of Commerce who was leading the delegation along with the Chinese Vice Premier He Lifeng. He said essentially that the two sides had reached consensus with the United States on the Geneva Agreement. And that's the critical part. This wasn't necessarily negotiating the terms of that Geneva truce. This was reestablishing the framework for that truce. Now, we have to see, the devil will be in the details on whether this means an extended pause of those high tariffs, because after the truce, the tariffs came down 30% from the U.S. on China, 10% on China to the United States. Now, the key component of this for the United States was the freer flow of those rare earth minerals and those magnets. This is what Howard Lutnick, the Commerce Secretary, had to say just a few minutes after midnight London time, following the conclusion of the second round of trade talks, 2 days of which were held there in London.
We do absolutely expect that the topic of rare earth minerals and magnets with respect to the United States of America will be resolved in this framework implementation. That is a fundamental part of that. Also, there were a number of measures the United States of America put on when those rare earths were not coming. You should expect those to come off sort of, as President Trump said, in a balanced way. When they approve the licenses, then you should expect that our export implementation will come down as well.
So Lutnick was talking about the U.S. export implementation that would come down in time in a balanced way. We're talking about chip design software, jet engine parts, chemicals, and nuclear materials, not necessarily the high-end AI chips like the H20 from NVIDIA. But again, they were asked about that. They didn't comment. Jamieson Greer did not comment on that, leaving it to the next round of maybe working groups to start hashing out what they can agree on, now that they've agreed and had reached consensus on the framework of the intent of the Geneva truce.
Steve, as you say, that they also didn't really schedule the next sort of meeting as well. And I have to wonder, right, with that U.S. Federal Appeals Court saying that Trump tariffs are going to be staying on for longer, what does that mean? Are we talking about months of still uncertainty there on that front?
There's going to be months of uncertainty regardless of what the courts say in the United States. There will be challenges, and there will be all kinds of machinations between the two sides as they try and get the best deal possible for their respective countries. Now, there is a clock element to this. The clock is ticking on those on the pause of reciprocal tariffs between China and the United States, extended by that Geneva truce till August 12th. So there has to be more talks between now and then if that pause is going to be extended, obviously. Even more pressing is the reciprocal tariff pause deadline of July 9th for other trading partners. So less than a month from today. That's why you're seeing India, Japan, South Korea, other trading partners sort of, I guess you could say, racing against the clock to come up with some sort of trade deal with the United States to make sure that their economies are not hit with those punitive tariffs, beyond the 10% baseline effect that is imposed on all trading partners right now. There's been only one trade agreement so far in this truce regarding the reciprocal tariffs from the United States, and that's with the UK. You can expect over the next 4 weeks until that July 9th deadline that there will be a fury of different negotiations, not just between China and the United States. Jamieson Greer, the U.S. Trade Representative, was asked about that. He was also asked about the court case extending Trump's ability to extend those tariffs. He said, we're not talking about that. They weren't brought up. We're going to leave that for the other talks that are subsequently going to be happening between now and those deadlines.
All right. As we await, of course, Presidents Trump and Xi to approve what was discussed in London. Steve, thank you. Our chief Malaysia correspondent, Stephen Ingles, they're joining us there in our Hong Kong studios. Let's bring it back here to the Conrad Hotel, where the Bloomberg Invest Hong Kong Summit is underway, and get the view from China. This is the panel that's going on with Qiao Liu, the Dean and Professor of Finance from Peking University. He's speaking with our Greater China Senior Executive Editor, John Liu. Let's take a listen.
In this area, I think that will improve the allocative efficiency. That can also help improve productivity growth. Yeah.
So over the next 5 years,
yeah,
your expectation would be for deregulation, reform in areas such as hukou, internal migration, in financial services, anywhere else?
I think that those reform measures have been laid out in the third plenary session of the 20th Party Congress last July. And yes, you're right. Supposedly they should be complete by 2029, before the end of the 15th five-year plan. So we'll see. Yeah, I think that could be launched gradually. Yeah, one by one. Yeah.
The other part of that for increasing productivity is technological innovation. What does the government do to increase the possibility of technological innovation? How does the government feel that?
Yeah, so I think this is why I think the sentiments about the Chinese economy all of a sudden have changed a bit this year, because of two things, right? Number one, I think DeepSeek. I went to U.S. in March. I talked to a lot of economists and also people working in the think tanks. Everybody's talking about DeepSeek. So I think that is a sign which showing that the foundation of Chinese economy actually is shifting. So I think AI and the big data-driven transformation is going to become one of the major parts of economic growth going forward. And the government has been, I think, promoting that. So in China, you're talking about the digital transformation everywhere. You're talking about the digital economy everywhere. Even in our schools, right, we have the new major the management and economics of digital economy. I think the demand for talents in those areas is huge. So I think that is something China is hoping for, because you can argue that AI and big data, they are general purpose technology. So they have a huge number of application scenarios. So if they can be applied and they can change current industries, or can somehow create some new industries, that is going to be a big boost for TRP growth going forward. I think that is one story. Another story I think people have talked about is climate change. People just argue that climate change actually is a constraint, but I think it's also about investment. For example, we have this estimation: if China, the whole world, wants to achieve a zero net emission by 2050, I think beginning in 2030, the total investment per year for that purpose is.
All right, we'll leave that there and watch really what's going on as we count down to this market open. And it looks like, April, we're taking a look at what's going on in Hong Kong, and the offshore market continues to be seeing a lot of momentum right now on the back of these trade headlines.
Certainly, and I think we've been seeing it, near those bull market levels, whether you're talking about the MSCI China or the Chinese shares in Hong Kong, the Hang Seng China Enterprises Index. So that positive momentum feeding through from the US-China trade talks. But I think what investors will still want to see is details from these negotiations. Look at how quickly the renminbi erased some of those earlier gains, although these positive sound bites from Howard Lutnick on the optimism that the rare earths magnets issue will be resolved seems to be feeding into some of these rare earth stocks on the mainland. Flip the board and take a look at Hong Kong as well. We are keeping a close watch not just on some of these biotech names that have been rallying, also the Chinese e-commerce names in focus, because China seems to want to tighten supervision for live streaming. So among the sectors that we're watching, even though the focus is still on these US-China trade talks.
All right, April, thank you so much for that update here. I'm now here with Matthew Michelini, partner and head of Asia Pacific at Apollo, and he's going to be speaking here at the Bloomberg Invest Hong Kong later this morning, talking about Japan's private credit boom as well. Okay, I don't want to take too much of the spotlight on Japan a little bit later on, Matthew, but let's talk about just overall what we're seeing in the macro outlook and the like. It seems like public markets, at least, are really, gripping themselves on over what's going on with trade. How much visibility is there in the private space right now, the companies that you own and the investors that you talk to?
It's actually been, the trade volatility has actually been a positive for private capital, or private credit at least, out in Asia, for a couple reasons. As I travel around the region, and I go to Japan, I go to Korea, I go to Australia, if before the tariffs, they were going to invest $100 into the U.S., they're now doing $100 or they're now doing $70 into the U.S., $30 somewhere else. Most of that somewhere else is Southeast Asia, it's India, it's Australia.
Have you seen any signs of stress, though, at least? I mean, obviously, tariffs, they don't weigh on borrowers in any way?
There hasn't, a little bit on the cross-border for companies that are serving the U.S., but they're rethinking their supply chains. And that's actually created an opportunity for us to finance the supply chains, especially as they get overweight with product and they need to put factories in different countries. And so as everybody rethinks their supply chain strategy, it's actually been a big positive for private capital.
What does that leave valuations then? Should I assume that things should be adjusted higher or lower in the region?
It's hard to say on the equity side because most of our focus is on private credit or on senior equity. But on private credit, we're still seeing good spreads, and we're putting a lot of money to work in Australia, we're putting a lot of money to work in Southeast Asia, at comparable spreads to what we're finding in the U.S. and Europe.
There are some naysayers out there that say, the glory days of private credit are over. You're starting to see fundamental headwinds, a global slowdown possibly here in the face of this trade war. And coming at a time when public and private markets seem to be converging in some ways, where the pricing of direct loans is moving closer to public. Are the glory days over, do you think?
No, well, I don't think the glory days are over. And I think what the trend you're talking about is direct lending or sponsor lending in the U.S., where it is going to be a cyclical business, and it is a cyclical business. But the private capital trends out here are actually more structural factors benefiting our business. I was shocked when I came out here. I would have not guessed that we would have had a large partnership with a Japanese bank to buy assets off their balance sheet. But we do. Because private capital out here is finding the productive way to partner with banks, with companies, and with sponsors. So it's actually a structural factor where private capital is filling a gap that the banks can't fill today.
Do you need to subscribe a certain premium on private markets over public now, in exchange for the loss of liquidity?
In Asia, there is less liquidity in the private markets than I think what you're seeing evolving in the U.S. You do earn a premium for being private versus public.
Yeah. What is that gap right now?
Anywhere between 150 and 200 basis points.
Okay. What if in a downturn, right? There's a lot of talk about this asset class that saw a rapid rise when global rates were essentially at zero. It hasn't been test-proof in a way when things slow down in the world economy. What happens then to private credit?
Well, I think you're already seeing it. There's some recent stats about amend and extends going up, the amount of PIK going up, or the amount of PIK is going up in underlying funds. I think you're going to see increased defaults and restructurings, but a lot of these private credit lenders are going to have to look at their book and see how they underwrote it. If you're a 2020, 2021 vintage loan and you underwrote a deal with low rates and low inflation, you're going to have a much different terminal value and cash flow profile when you go to refinance that loan than some of the later vintage loans.
Something that's also a trend that's happening in Asia is that, some, asset managers are tapping into retail investors to get into the private credit space. I mean, this is, as you say, illiquid, not a whole lot of know-how, really. How does that change the dynamics of this market if there is a domestic or retail investor involved now?
Yeah, you haven't seen, other than in Australia, you haven't seen private credit managers in Asia tap that retail market. It's really been for global product. And it really depends on the underlying manager. For us, where we buy everything onto our own balance sheet that we buy for retail or that we buy for institutions, our job is to protect that capital. But what you saw out here in Asia is you saw a rotation from local equities and local real estate into private credit because you could get 10% yields. In theory, with low volatility and low default risk. And one of our flagship direct lending products has sold very well because of that, and they like the fact that we're buying these loans right alongside them.
Matthew, I know you're spending a lot of time all over the world. You're going to be about to talk about Japan and the credit boom that we're seeing there. In terms of geographies, where are the sort of the untapped sort of opportunities now?
So I was in Australia yesterday talking with some of the government officials, and they have no idea where the long duration capital is going to come to support the industrial renaissance that we've talked about, which is a global theme. And same thing in Japan. You look at the average loan on a Japanese bank balance sheet, it's 3 years in duration. And all-in yield is about 175 basis points. So it's really, really high quality and really short term. And these countries are running with fiscal deficits, and they're asking themselves, where does the capital come to finance these longer-term projects? And that's where private capital is going to step in. But I'd say right now, Japan, Australia, and a bit of Southeast Asia.
Matt, we got to leave it there, but thank you so much for joining us.
Thanks, Yvonne.
Matt Michelini there from Apollo here at Bloomberg Invest Hong Kong. Tune in with his session with Chanel Bessent. It's going to be happening around 11:15 here Hong Kong time. And we have more coming up from Bloomberg Invest. Starting soon is our panel on Trumponomics. Certainly very timely here. We're going to hear from Morgan Stanley's chief China economist, Robin Sheng. He'll be with Hao Hong, managing partner and CIO at Lotus Asset Management. This is Bloomberg. Well, to a Bloomberg scoop right now, we're learning that Treasury Secretary Scott Bessent is emerging as a serious contender to succeed Jay Powell as the next Fed chair. Our sources say several advisors close to President Trump are pushing him to appoint Bessent when Powell's term ends in May next year. For more, let's bring in our global economy correspondent, Anna Curran, joining us live from D.C. And thanks for staying up for us. And really, what do we know at this point about his chances of really becoming the next Fed chair?
Well, so the backstory here is President Trump last week said he's close to announcing who will replace Chairman Powell when Chairman Powell's term ends in May 2026. So that's kind of ignited conversation around who might be on that list. And my colleagues here in DC are reporting out that actually Treasury Secretary Bessent is being talked about by people both inside the administration and outside. He's obviously highly regarded. He's the chief salesman for the White House economic policy right now. And of course, he's handling very fast moving and changing policies, be it on the tax front, the fiscal front, and of course, the trade talks like we saw there in London tonight. Now, the White House have pushed back against this idea, and Secretary Bessent himself has made the point that he says he already has the best job in Washington, and that ultimately it's up to the president. So, element of a parlor game here in terms of who might be named. There are others on the list too. Kevin Warsh, a well-known academic who was previously a Fed official. He's obviously another one of the key names that gets talked about. And of course, ultimately, we don't know when this decision will be made, given Chairman Powell does have from now until May 2026 before his term is up. But no doubt, there's some people inside and outside the administration that are raising the name of Treasury Secretary Bessent as one possibility.
One possibility, what would be Bessent's sort of stance on monetary policy right now? Of course, we've heard President Trump pressure Jay Powell into cutting rates. Obviously the Fed has been hesitant to do so far, and markets are pricing maybe less than 2 rate cuts this year. So, how would it change if in the case of Bessent really becoming the Fed chair?
Well, it would be fascinating. I mean, you're right, Yvonne. Obviously, President Trump has been publicly critical of the Fed, as recently as last week, saying they need to cut by 1 full percentage point. He says Chairman Powell has been too late to move. So, there's little doubt in terms of what President Trump wants. The Fed, of course, plows its own course. It remains independent. But, Treasury Secretary Bessent is the chief salesperson for the White House administration. So if you were hypothetically to get into a scenario whereby a Treasury Secretary went from the White House to the Federal Reserve, to the central bank in any country, well, obviously the optics around that would be, you might be carrying the leanings towards pursuing the ongoing policy of the White House. And, would probably stoke speculation and analysis that maybe Treasury Secretary Bessent would be quite a dove if he was to take on that kind of a rate-setting job at the Fed. But of course, ultimately, it needs to be made clear that the Fed is all about growth and employment and controlling inflation too. So it's not like there's a major divergence in what either side want. It's more about the optics and the timing and the judgment of when to pull the levers on monetary policy. I think that's what the real difference is right now. But you know, as I say to you, if there was to be a scenario whereby a Treasury Secretary or any finance minister went from the government to the central bank, obviously there's always going to be optics around that, and they would have to be reassure markets and be very careful how to navigate that the central bank maintains its independence from the political masters.
And thank you, Anna Curran there, our global economy correspondent, joining us out of D.C. And it really is the perfect segue to a panel that's going on right here at Bloomberg Invest Hong Kong. Trumponomics, our very own head of economics and government, Stephanie Flanders, is talking now to the likes of Robin Ching from Morgan Stanley, also Hal Hong from Lotus Asset Management. There you are. You're seeing Rebecca Chung-Wilkins on stage as well. Let's listen in.
Expedited process or allow these rare earths to continue being exported into the US. We do not have any details on what that might mean, and both sides still do need to go back to their respective leaders and effectively run this by, their bosses.
But on the other side, there had been some sort of excitement in the last couple of days when the Commerce Secretary, Howard Lutnick, actually mentioned export controls and was also apparently thinking about some of the US export controls on China, which have been a very sore point for the Chinese. Do we have any clarity on which of those controls were discussed? Because there's some are much more important than others.
Absolutely. So sort of yes and no here. So we think that some of the immediate retaliatory export controls that the US rolled out when they believe that the Chinese side were not living up to their expectations and the agreement on rare earths will be lifted. So that includes restrictions on things like domestic technology for software technology for developing semiconductors, nuclear materials, chemicals, some jet engine parts. So these are the latest package of retaliatory measures that we've seen coming out of the US since that breakdown in the Geneva Truce. It's unclear if this will involve some of these more fundamental issues over export controls over semiconductors. That, of course, is the big sticking point, these restrictions that were rolled out under Biden and continue to be expanded. So part of the small yard, high fence range of measures.
Okay, well, Robin Singh, you don't have to, of course, Rebecca has to stick to absolutely what she knows, but you get to just speculate wildly on the basis of very serious economic analysis. How are you reading where we've got to? And I guess, what will you be looking for in terms of the sort of economic impact of these ongoing talks on China right today?
Thank you, Stephanie. I like the word you used, speculating, given all this flip-flop about trade talks. So far, the bid-ask gap between US and China is still very wide. If you look at the readouts from the US side, they are later focusing on trade deal, on upcoming logistics for rare earths, as Rebecca, you elaborated. But the Chinese version, Beijing's readout, covered a much bigger picture. They want to reset the grand relationship between US and China, covering tech curbs, student visa, geopolitical issues. So apparently Beijing wanted a grand bargaining deal. So I think there is a huge gap between the bid-ask, and that means the ongoing talks won't be easy. Maybe they can extend this trade tariff detente, but what Beijing wanted is beyond tariffs. And Rebecca, you mentioned the rare earth. Now China is using it more like a strategic card because of the tech curbs. So what you said is like Beijing thinking, if you cut our chips, I will cut your magnets. And over the last 7 years, since the first trade war in 2018, China has strengthened its dominance in key supply chains like rare earths. Today, they control more than 80% of rare earth refining capacity, more than 90% of the magnet production, which is widely used in next generation of tech and supply chain, including EV cars, humanoid robotics, even modern defense system. So now China is using that in exchange for potential relaxation of tech curbs. That's also part of Beijing's strategic play, sending a message to U.S. allies, it's making them think twice about aligning too closely to the tech curbs on China. So I do think all of these showed China wanted a grand bargaining deal covering not just the tariff, but the tech and geopolitical issues. Given that's not going to be easy, you may see continued uncertainty on trade talks. So our base case is by end of this year, the U.S. terminal tariff rate on China will probably stay similar to today's level, 30%, 40%, given all these difficulties and the divergence of Beijing and Washington's readouts. And that's going to cost the foreign firms margins, cost the Chinese exporters jobs. So it's still a downside risk to the economy.
How Hong, I guess I'm struck by, it feels like the U.S. side had not fully grasp how reliant...
We're going to leave it there, but subscribers, you can continue to watch live and see our past interviews in our interactive TV Go function. So TV Go is where you'll see all the interviews and panels that we're having here at Bloomberg Invest today. Also become part of the conversation. You want to send us instant messages, questions for our guests throughout the shows. Check it out at TV Go. Checking movers here this morning, and we're focusing on Taiwanese insurers. So they did report some monthly losses there. So we are seeing quite a bit of downside on some of these insurers there in the island today. You take a look at how Shenzhen as well. So anything related to Shenzhen, we are seeing some of them seeing some pretty punchy price gains here on the back of the State Council approving a plan to drive economic and financial reforms in the city as well. Overall, though, it is looking to be a really up-arrow story when it comes to China. You take a look at how stocks are doing, and it really is on maybe the onshore market that is playing a bit of catch-up here to what we've been seeing and the action that we're seeing in Hong Kong, right? 1% gains with CSI 300. Keep in mind, we're still about 8 or 9% off some of the lows that we saw in April, so not quite there in terms of bull market territory just yet. But we'll continue to watch what happens here on the back of this consensus that was reached in London when it came to Geneva. We'll have a lot more coming up from the Bloomberg Invest Hong Kong. You're watching The China Show. Welcome back to The China Show. We're back and we are on location at the Bloomberg Invest with our panel on Trumponomics right now. That features our very own Rebecca Chung-Wilkins alongside Morgan Stanley's Robin Shing and Lotus Asset Management's Hao Hong speaking to Stephanie Flanders there. And I want to bring in the host of the show who abandoned me to be on stage here this morning, of course, David Ingles. He's back here now.
Yeah.
How are things going in there?
I just actually stepped out of this ongoing panel. I ripped my body apart to be part here, part there. My heart, though, as we all know, of course.
It's always here.
There we go. What's interesting about what's going on there, right? So the big news today, and I think Steve is going to talk about this almost reset that's taking place, and to what extent is it progress? And to what extent is it actually just we're back to square one?
Yeah.
And I think the point they were making inside is very interesting because the key sticking point to the disagreement from Geneva was rare earths.
Yeah.
And I think the point that Morgan Stanley's Robin Shing was making was there was a big difference between, and how he framed it was there's a massive gap between the bid and ask of the U.S. and China.
Misconceptions between both sides and what was agreed upon.
What was agreed upon, right? The U.S. was very detailed on the trade agreement. Beijing's readout, Robin Shing said, was really more big picture, a grand bargain on tech and those things. So it just sets the stage for still, while it is a reset, there's still a lot to be done. And likely we will see a lot of perhaps disagreements along the way because of just how wide the starting points are.
Well, you spoke with Paul Chan, the financial secretary, who really kicked things off here. How did he see this whole dynamic really benefiting Hong Kong in some ways? Because he talked about this pipeline of IPOs, and he was still quite optimistic about how things are going.
I mean, it was the reality, he said, and we framed it perfectly almost with our interview that we did with Stephen Roach, who said that he had this change of heart because of the IPOs. And he said, Hong Kong is the safe harbor for all things when it comes to the weakness in the dollar. People, you have to think about mega trends, is what he's saying. And Hong Kong controls some things, doesn't control everything else.
Yeah.
It's investing in mega trends, things like if Chinese companies want to raise capital for future increases in capex in Southeast Asia, supply chains, Hong Kong is the place to be. So yeah, so he talked about that. The assumption he's making as far as the economy goes is they have to, of course, think worst case and what will happen to growth. So far, he thinks, well, things are stable.
Yeah.
And the interest rate environment is an interesting window right now when you look at HIBOR, for example.
Yes.
Take advantage of lower rates while you can, but keep your seatbelt on as well, is what he said.
And I think he was so firm when you said the peg is in place. He goes, yes.
That's it.
Nothing else to say.
Full stop. Full stop. Because it's worked since 1983 through different cycles.
Yeah.
So he said that stays, and it's the government needs to be very clear in its messaging that is not even up for discussion.
Oh.
Yes.
So let's not even talk about it, right?
No.
We're going to get to take on markets because there has been some relief when it comes to what happened in London, right? Yes, it's just a framework right now, but certainly just the fact that both sides came with some sort of consensus, I think that is the buzzword here today.
Yeah.
And you are seeing still MSCI China, 8 shares are extending those gains after entering to the bull market. The CSI 300 here today, it seems to be doing quite a bit of catch-up here this morning as well.
Yeah, and I think that was the starting point as well. We talked about with Paul Chan that it's almost like we planned it and we scripted it, and we entered the bull market going into the show today. And we are seeing that this sort of sigh of relief in equity markets. But yeah, I think Averill is on top of the market story for us. We're up 0.6% on the Hang Seng. Averill, what are you seeing?
Yeah, we're seeing the EV makers sort of the big boost for the Hang Seng today. I think part of this is how BYD is, pledging to pay their suppliers on time. But to your point about this catch-up play, it's interesting to see how the mainland benchmark is outpacing these gains on the Hang Seng. It's boosted by the consumer discretionary, the financial-related stocks, and I think adding to this optimism from whatever's come out of these U.S.-China trade negotiations, that at least they've been talking, there's some sort of consensus on this. But also interesting, if you just flip the board and take a look at this next chart, courtesy of our M-Livers, specifically Mary Nicola, because it's been really remarkable how Chinese stocks have rallied even in the face of sluggish economic data. And then the question then becomes, is this because bad news is good news for stocks? This chart actually shows you how there have actually been positive correlations when it comes to the MSCI China, along with data beats. So this also suggests that along with all these positive headlines we're getting today, if these macro data points continue improving, then the stock rally could be turbocharged, so to speak. Now, flip the board, take a look at what we're seeing in the rest of Asia today as well. We are seeing the gauge for the region sitting in the green. The big boost is what we're seeing on TSMC, and this is following on from reaction for its May sales data, but mostly a positive day. We're seeing U.S. futures sitting a bit lower, though, so interesting to see that. Maybe this is part of what Robinson was talking about, right? That gulf when it comes to the U.S. and China, that bid-ask gap there. Yvonne?
Yeah, right? The devil is in the details. We're not quite out of the woods just yet, but let's get a little bit more on what really came out of London and those trade talks between the U.S. and China, with an agreement on a framework plan which could revive the flow of sensitive goods between the world's 2 largest economies. Stephen Ingles has been tracking everything on really bringing us up to speed, Steve, on where we stand right now from London.
Well, it resets it back to where we were in Geneva 4 weeks ago when they reached that truce, and then things got a little bit off track. Those are the words that even Donald Trump had used, that trade discussions between China and the United States had gotten off track, but now they're on track. So, again, when you have Scott Bessent and Howard Lutnick and Jamieson Greer meeting across the table for 2 consecutive days, including until midnight on Tuesday, where they wrap things up, across the table from He Lifeng and also the Vice Commerce Minister of China, Li Changgang, they came to a consensus. And that's a term that was used essentially by both sides. And it was the Chinese side. It was Li who has become sort of the face, even though He Lifeng leads the delegation. The Vice Commerce Minister Li speaks fluent English, and he was out even before Lutnick and Greer spoke to the media, saying that they've reached consensus, and he hopes that this consensus will be conducive to building mutual trust. And that's been a big part of the Chinese argument. They need to bridge the trust gap that widened even further after that truce in Geneva, and things derailed a little bit because of further export controls that were issued by the United States, and also what the White House said was a fairly slow licensing process of rare earths coming out of China. This is what Mr. Lutnick, the Commerce Secretary for the United States, had to say on that issue, whether China, in this agreement overnight in London, is going to speed up the process of export licenses for critical rare earths and magnets for the United States.
We do absolutely expect that the topic of rare earth minerals and magnets with respect to the United States of America will be resolved in this framework implementation. That is a fundamental part of that. Also, there were a number of measures the United States of America put on when those rare earths were not coming. You should expect those to come off sort of, as President Trump said, in a balanced way. When they approve the licenses, then you should expect that our export implementation will come down as well.
So while these talks, as Jameson Greer really emphasized, were really big picture, getting that framework agreed to, there was, as you heard from Howard Lutnick there, some specifics, including on those rare earths and the rare earth magnets, as well as bringing down what China had wanted to see, bringing down those other export controls that the United States had added after that Geneva truce, such as chip design software, jet engine parts, chemicals, and nuclear materials. But again, the details of which sectors will be still targeted at certain rates and what will be expedited, et cetera, will be the fine nitty-gritty details that will be hammered out now that they have a framework agreement in the subsequent weeks. But again, the clock is ticking.
Yeah, Stephen, they have to go back to their respective bosses. And, big picture is important. It's really the details that matter here and really what markets care about. I guess my question is, are we actually any better off today compared to the day after Geneva? Are we simply back to square one?
I think we've resumed the goodwill that was established following the Geneva truce. Because what happened, let's rewind 4 weeks. I mean, the United States and the Trump administration basically unwound those 145% tariffs down to 30%. And China also unwound its tariffs down to 10%. That was a significant move. But things got off track in the subsequent 4 weeks until last Thursday, you had that phone call between Xi Jinping and Donald Trump. And when the top two leaders have essentially goodwill and agree to intent of their discussions, then that trickles down to all the agencies and all the working groups and all the negotiators. So, yes, I think we have moved the ball forward on finding trust and finding an eventual agreement that will bring those tariffs and the trade war temperature down. Again, the devil is in the details, and what subsequently will happen between now and August 12th, when that pause that was reached in Geneva 4 weeks ago is due to expire. So there needs to be more goodwill, more progress, more talks until August 12th. It's an even tighter time frame for other trading partners that face a July 9th deadline to reach their own deal to avoid possibly a resumption of those high tariffs, reciprocal tariffs.
All right, July 9, August 12, say goodbye to your summer. It's not going to be a quiet one, certainly. Steve, thank you so much. Stephen Engel in our Hong Kong studios. And really now, against that backdrop, we had this conversation earlier on here at Bloomberg Invest with Paul Chan, Hong Kong's financial secretary. But really, he started off by talking about how things have remained stable, the importance of things remaining stable. Have a look.
The outcome is somewhat expected, but there are bound to be volatility, ups and downs. So we won't underestimate the challenge. For us in Hong Kong, concentrate on doing the right thing. On the one hand, ensuring financial security, financial stability. And on the other hand, in terms of international financial center status, in terms of our trading hub status, as well as a rising technology and innovation hub. We concentrate on these three fronts to move forward to drive our economy to continue to grow.
What are your expectations for the economy this and next year?
This year, the estimate GDP growth is 2 to 3%, as indicated in the budget. The first quarter performance was impressive, 3.1% growth. Export strong, private consumption a little weak comparatively, given the changing spending patterns of Hong Kong residents and incoming visitors. This is understandable, and we help the industry to transform, to reinvent themselves to respond to this change. This will take a little time. Investment also sustained. Into April and May, the figures currently available, exports still holding up, investment still quite good, stock market is doing quite well, and the pipeline is strong. So we expect this year the stock market will continue to be strong, and this will give support even to private consumption.
Right. The wealth effect, as they say, in fact, quite timely. It's almost like we planned it yesterday at the close. The Hong Kong stock market, specifically the Hang Seng China Enterprises Index, actually entered a bull market as of the close yesterday. It's almost like we planned it. We'll just say we planned it. We'll just say we planned it. On the market side of things, one of the big highlights this year has been the return of big listings in Hong Kong. We have had a massive one, CATL, a few weeks ago. Just give us a sense of what's in the pipeline.
Well, CATL is a classic example, drawing a lot of attention, and also, the DeepSeek moment, causing the foreign investors to reassess, number one, the technical capabilities and innovations on the mainland and the possible investment options. Number two, people find that perhaps earlier on, last year, say, for example, they had underweight their allocation to this part of the world. So you saw funds flooding in. We have looked at the IPO pipeline, very strong. On the one hand, given the geopolitics, it is getting more difficult for tech stocks, say, for example, to go to the US for listing. Then if they sit for international listing, Hong Kong is natural destination. And also, as you mentioned, the return of the China concept stocks. I've already asked my colleagues in the Securities and Futures Commission and the Stock Exchange to get well prepared for them to come back to facilitate this listing.
Should we expect more big listings this year?
More to come, actually, more to come. The pipeline is very strong, and also the central authorities are very supportive of this move, encouraging the mainland major companies coming to Hong Kong for listing.
Yeah, there we go. That was Hong Kong Financial Secretary Paul Chan with Yvonne Man's co-anchor there at Bloomberg Invest, where we are, of course, here today. We've taken the China show on the road. Right, just to pivot stories here, the other big one that we're tracking today is the U.S. Appeals Court has now ruled that President Trump can continue to enforce his global tariffs for now. That's a win, of course, for the president on one of his signature economic policies. For the details in the story, Bill Ferries joins us, our senior editor from Singapore. Bill, what do we know?
Yeah, so this is basically an extension of that pause that the appeals court put on that ruling that really kind of shocked markets and shocked the U.S. government. The trade court ruling that said President Trump's tariffs on a whole range of countries, those reciprocal tariffs, were not legal. The appeals court had stepped in initially after that ruling to put a pause on that decision. As it kind of went through the different legal arguments, it has basically extended that decision through the end of July at this point, which is when they'll meet again to take it up. But it is still a big win for the Trump administration at this point, particularly given that the administration is continuing trade talks with China and continuing trade talks with a whole range of countries that were getting impacted by those reciprocal tariffs. It doesn't mean that the court won't ultimately rule against the administration, but it does give it another essentially 6 or 7 weeks to continue going forward with those talks without the threat of them being pulled away, hanging over the administration.
Bill, you mentioned, right, trade talks are still ongoing with many, many countries. We're less than a month away from that July 9th deadline. We're hearing, though, that there might be some progress made between the U.S. and Mexico now. What's the latest?
That's right. It does seem like, at least on the issue of steel imports, Mexico might secure something it very much wants. The talks at this stage are centering around Mexico being able to send steel into the United States without any duty, without any tariff at all. Right now, under the administration's policy, they would face a 50% tariff on that. Essentially, this would eliminate that tariff and allow them to export to the U.S. up to a certain threshold, which is higher than historic levels. So that's something that would be quite a breakthrough for the U.S. and Mexico on trade. This deal is still tentative. It has not gone to the president's desk. He has not weighed in on it. Commerce Secretary Howard Lutnick has been the point person on this. But it does show the administration's, I suppose, their willingness and ability to get close to a deal that would actually eliminate tariffs as opposed to putting some kind of a floor on them.
Bill, thank you. Bill Ferry is there, our Bloomberg senior editor, joining us live from Singapore. And we got plenty more coming up from the Bloomberg Invest Hong Kong summit here. We hear from the two CIOs, right? Steve Bryce from Standard Chartered and Jean Cha from Bank of Singapore, discussing investing in a world without order. That conversation with Bloomberg's Eric Schatzker starts in just a few minutes' time. You're watching The China Show. All right, talk about investing now. Let's go straight to our next panel at Bloomberg Invest Hong Kong, where Eric Schatzker is talking to Steve Bryce, Global Chief Investment Officer at Standard Chartered, and Jean Cha, Bank of Singapore Global CIO. The headline is investing in a world without order. And the first question Eric's asking is, what did the CIOs get wrong so far this year? Let's take a listen.
The recalibration of trade policies, to put it politely, but we did see that pull back, and then obviously now we've gone to the races again. Actually, I think that's the key. I think and a similar point actually to Jean's in terms of what we got wrong. I don't think we didn't see the dollar weakening to the extent that we've seen it now. In the big picture, we are back to about the middle of the 5-year range. So that's not, I think there's a lot of over-dramatization about the dollar weakness, and I'm sure we'll talk a bit about the outlook here. So yes, we've seen a 10% drawdown in the dollar on a broad-based basis, but really we're just at the bottom of the range. So we haven't really broken out yet. But that clearly we weren't looking for a 10% down move in the dollar this year. So it's interesting where we go from here.
Each of you has to process as you figure out effectively what positions and allocation to recommend, an enormous number of variables. Of all those variables, right, that are going to have an impact on the outlook for global assets, which ones stand out to you right now as the most important, Steve?
I think it's not really a variable. Maybe we can look at it in one way where it is, but it's really to the extent that what's happened this year is a permanent shift higher in uncertainty and leads to a permanent recalibration or a semi-permanent recalibration of business intentions. So we've talked to obviously a lot of entrepreneurs, small business owners, and the key thing immediately after the Liberation Day was, what should I do? And the reality is, you should probably sit on your hands and see how this is going to play out. And just everybody doing that around the world leads to economic impact.
Sure.
So the question is, to what extent does that lead to a the genie being out of the bottle, and therefore, regardless of trade deals being done, etc., we could still go into recession. And the other way to look at this is the soft data, hard data gap has obviously been widening. If you look at economic expectations, the Economic Surprises Index, the soft data is underperforming massively, and the hard data is outperforming massively. That's going to narrow. Which way is it going to narrow? And I think that's the biggest question that we've got to try and figure out as, obviously, if you're an economist, but also obviously as investors as well.
I think that's a very interesting concept, sort of structural uncertainty in a way. What about you, Jean?
So that's where we agree on structural uncertainty. The cause of it, however, I believe that we're actually in the midst of a very seismic shift in terms of the correlations as well as the decorrelations of the variables that we're used to is breaking down. For example, yields and the dollar, right? That used to be a correlation, but that's broken down because there's something underlying that's shifting in terms of calibration of risk. So I think that whole notion of DM versus EM and how we have invested in the past and our attitude towards fixed income portfolios, for instance. So that whole uncertainty means that we have to actually change the way we act. So quite the reverse from being shell-shocked. Our mammalian, as mammals, our response to an attack typically is you either freeze, fight, or you fly. Right? I think as human beings and very sentient ones in the room, we actually have to strategize. And so as a bank and as an investment team, what we've done is say that what is the strategic shift we need to do as investors? And so we looked at our strategic asset allocation framework and say to ourselves that if all these variables are breaking down, that forecasting ability goes down. Are we going to change the way we allocate assets? So we've gone through a whole robust optimization model, quite a lot of data involved, historical and also forward-looking, to recalibrate how investors should think about their portfolios. And I think the deep work we should be doing as individuals as well as investors is to say to ourselves, with all of that changing, the blocks breaking down, countries having different relationships from each other than we were used to post-Cold War, what does that do for our investment forecasts?
I want to pick up on something that Jean said, actually, in terms of the correlation. You talked about dollar and yields, but actually, if you look at it in the recent past, the dollar's actually looked like a risk-on vehicle, right? So if risk is doing well, the dollar's stabilizing if risk is off, which I think is probably the opposite of what people thought. Again, coming back to what we got wrong, you go, okay, risk off, dollar does well. Right, the dollar smile, the infamous dollar smile, right? So I think that's the challenge. So obviously a lot of people worried about how far the dollar could go. Actually, our view is that the market is massively underweight the dollar and US assets. So we could still see in the short term a melt up or climbing the wall of worry for US assets until that positioning corrects itself. But then longer term, you say, okay, is the dollar going to crack? Certainly Trump wants it to crack, right? That's one of his
All right,
policies.
we'll leave that conversation there, but for subscribers, make sure to check out TV and Live Go for more on this as well. In terms of movers in these markets, so certainly we're watching very closely what happens when it comes to tech, when it comes to rare earths and those stocks, which have really been flying the optimism from what's been going on in London and this U.S.-China trade talks here. Today, we're focusing on TSMC. So these tech stocks are gaining after what we saw from TSMC. May sales jumping some 40%. So you've seen the likes of SK Hynix up close to 4% in Seoul today. We're also watching China auto parts stocks. So car makers have actually made a pledge to standardize bill payment periods for their suppliers after authorities did voice concerns. So you are seeing these auto supply or auto parts stocks rallying this morning. We got plenty more ahead. This is Bloomberg.
But I think what everybody is sort of saying is, okay, I understand that the US is weaker in some sense in terms of policy certainty, but to what extent are other people picking up the baton from the US? And I think that's where people are struggling and saying, yes, okay, you've got German fiscal stimulus,
it's early days,
etc. You've got what China's been doing to sort of try and support the economy, etc. But it's just, it doesn't feel like there's an obvious person to take over.
One of the things, and you've both touched on this, but I'd like to go a little further. One of the things I'm particularly interested in understanding is how your clients are processing, if you will, what the Trump administration has been doing for the past 5 months. And there's a lot going on, right? You have, obviously, tariffs and Liberation Day and the threat of inflation, but also the threat of stagnation. You've got encroachment on monetary policy from the Oval Office. You have the big, beautiful bill and maybe an additional $2.4 trillion of deficits. You have the weaponization of the Justice Department, right? The potential withdrawal of the U.S. from global security alliances. I could go on. How are people thinking about this? Do they see this as being a structural change in U.S. policy? In other words, henceforth, the United States is a different place, and we need to think about it differently as investors.
So I think the starting point for me is, look, everybody realizes that the US is still very important from an investment perspective, right? So, but I think what we're seeing more and more now is that clients, yes, they did a knee-jerk going short duration, etc. But I think the people that take the portfolio approach that Jean was talking about.
All right, that was Steve Bryce there from Stand Chart, the CIO, talking about where to invest in a world with no order, right? That certainly is the key topic there with Eric Shasker here today. And Steve mentioned, right, where does the U.S. pass that baton to when it comes to investing, right? The diversification away from U.S. exceptionalism. He says there's not that many standout alternatives out there. But maybe China could be that alternative, right? Let's bring in Kinger Lau, Chief China Equity Strategist at Goldman Sachs. He's been tracking, of course, these bull markets that we're seeing in Hong Kong. Certainly there's a lot of momentum behind it, despite the fact that we trade around trade headlines almost every single day. And you're starting to see signs of the economy deteriorating as well. Why do you think markets are still quite bullish right now?
I think, as I said, Yvonne, I think that, based on our conversations with investors globally, I think there's a pretty strong demand out there from asset managers globally to diversify away from the U.S. market, whether it's from a geographic perspective or from a asset class standpoint. So as I said, when you think about the liquidity profile, valuations, positioning, and some idiosyncratic themes that you can monetize, I think China is one of the potential candidates that they can deploy some capital.
What's positioning like? What are the long-only funds? What are they telling you now in terms of interest coming back into this market?
Well, interest level has gone up a lot, given the questions and conversations that we have had with investors. But when you look at the hard data, the positioning data, I think we're still at the very low end of the historical range. To be precise, for more than $1 trillion of AUM that we track, this is sort of a global mandate. Currently, they allocate around 1% of the AUM in Chinese equities.
Wow.
And the benchmark weight for China in the global benchmark is about 5.
Okay. In terms of catch-up, though, I mean, it seems like all the action is really in Hong Kong. Can we expect onshore to actually catch up?
I think the answer is yes. I think if you take a step back and think about what's really driving the performance for the onshore markets, I think there are really two important macro variables. One is growth momentum, and the second is policy easing, sort of policy accommodation. And I think, at least in the near future, we think that these two factors are going to improve somewhat relative to market expectations. So combining that with liquidity is still pretty conducive. We think that there's a pretty strong case for China A to do better in the short term. But strategically, I think if you want to play the AI story, I think most investors will still believe that Hong Kong is a better place to be in.
Yeah, what's really driving this bull market is AI. But then again, on the flip side, it's still the dividend plays, right? The income strategies, which is really seen as more of a defensive play.
Yes.
Explain those two dichotomies to me. One is more growth, one is more defensive.
Well, I don't think it's a sort of a binary decision. I mean, it doesn't mean that you can only buy AI but not buying dividends, right? So I think the market is big enough and the investors base is big enough to have both in their portfolio. Now, I think we clearly have been emphasizing the importance of getting cash returns or total shareholder returns from buying high dividend yielding stocks as well as companies that are more aggressive in doing buybacks. So let me give you the number. In 2024 fiscal year, we aggregate more than 6,000 listed Chinese companies' financials together. And the aggregate dividend and repurchase notional amount was 3.5 trillion RMB. That was the historical high. And we translate that into your returns, shareholder return space, you talk about more than 3%. Which is quite significant, particularly against a backdrop where your 10-year bond yield in China is now below 2%.
And is that mostly the banks? Is the dividend plays still?
I think it's quite diversified across sectors. Banks definitely have been one of the key areas where you can get some pretty stable and high dividends. But outside of that, you talk about infrastructure companies, power companies, even consumer names. They are turning more aggressive.
It almost seems like even, with the threat of tariffs, that these markets can still do quite well. I'm just wondering, once the hard data starts to deteriorate further, what if we don't see any sort of trade truce after the 90 days? What could be the worst case scenario for Chinese stocks if, in fact, we see tariff levels go back to triple digits again?
Well, this is not our base case.
Of course, bear case.
To begin with. So I think where we are now in terms of market pricing is very close to our base case assumption in terms of our tariff assumptions, growth estimates, valuations. So right now, MSCI China is trading at about 11.8 times for PE, and our target is 12. So we're very close to that fair value level. And our 12 times PE is predicated on 40% effective tariffs from the US on Chinese goods. On top of that, about 4.6% GDP growth. And to counteract the external challenges or uncertainty, we believe that the policymakers, the authorities, will come up with more forceful and aggressive policy easing down the road. So if there's further re-escalation of trade tensions, our base case suggests that the policy easing sort of intensity could rise from here.
You had a pretty interesting note a few weeks ago talking about how the renminbi and the strength that we've seen is actually going to generate better returns and boost equity markets. I think 1% appreciation of the yuan, you say, can help and boost 3% of equities.
Yes, that's a rule of thumb, yes.
Can you explain how that translates?
Well, I think if you take a step back, I think there are really three major transmission mechanisms. One, particularly for the Hong Kong market, given all the stocks are quoted in Hong Kong dollars, but your underlying assets are in RMB, right? So when you report in Hong Kong dollars, obviously you talk about translation gains. Second channel is transaction gains. So particularly for companies that have US dollar denominated debt or have US dollar based input costs, right? You should benefit from that currency change. And thirdly, from a macro perspective, I think a stronger currency in China would imply less pressures for capital outflows, which should benefit equity risk premium in general. So when you combine that all together, the historical relationship, as you said, is 1% appreciation of the RMB against the dollar, would translate into above 3%.
And what are the winners and losers of this renminbi strength? You've kind of had to rejig a little bit.
Well, I think the winners, particularly quite clear, are basically companies that hold a lot of RMB or domestic assets or more domestic focused. So that's why we think that domestic consumption is still thematically one of the areas that we are very focused on, in particular the service consumption area. So this is the sector that we're overweight in our sector allocations. But when it comes to potential laggards or losers, obviously exporters, particularly those really sort of focused on the US market, I think they could be under somewhat pressure.
Where do you have the least conviction now in this market?
Least conviction?
Least, yeah.
Trade, the trade negotiation, so the export, so the outlook regarding exports, as you said, is still very highly uncertain. So that's why I think against that backdrop, our strategy is really focused on domestic. Right, this is something that we can control. And I think policy setup is much more flavorful now. So I think investors should really kind of focus on alpha, particularly domestic-driven alpha opportunities.
Kinger, great to talk to you again. Kinger Lau there, Chief China Equity Strategist at Goldman Sachs, joining us here from the Bloomberg Invest conference. Well, the latest framework really around trade was this agreement that was struck between the U.S. and China in London, and it really marks another cautious step towards easing tensions. But our Bloomberg Opinion columnist Karishma Vashvani thinks it's only a fragile truce that could be reversed at any moment. Let's bring in Karishma now. She joins us with her latest opinion piece. Karishma, it's great to talk to you. So this is not really a reset, you say?
No, Yvonne, it's not a reset at all, and I don't think we should be seeing it as the beginning of some new romance between the United States and China. What it does do is provide a sort of fragile truce, which is a good thing, obviously, for financial markets, but also for the global economy, because so much is hinged or has been hinged on the outcome of the talks between the two sides. But this is a truce that is very volatile and could be disrupted at any point. And I think that's really important to remember. We've seen rapprochement turn into recriminations before, you'll remember, after the first sets of discussions in Geneva. And I think at the heart of this, the reason why it's so difficult for the two sides to come to any sort of long-term consensus on how they're going to negotiate with each other is because now trade is seen through the lens of national security for both the United States and China. Now, for Beijing, this is going to mean that every single thing on the negotiating table, they're going to want to get some concessions for, and they don't want to lose face. And for the United States, under Donald Trump, this is the way that he deals with trade transactionally around the world. So it's a very difficult impasse and standstill to try and break. We've seen some progress today, and that's positive, but we shouldn't take it as a sign of a reset.
Yeah, and we talked about the bid to ask, where there's still that gap between the two sides and some of the very key issues, as you highlighted there. So what is at the heart of this?
Yeah, you know, as I was saying, national security for sure, Yvonne, but one of the things that I think it is worth bearing in mind is whether there is room for compromise. We've seen, you know, the U.S. and China locked in this strategic rivalry for some time now, right? It's not just during this Trump administration. Arguably, it started in the first Trump administration when the trade war really kicked off at that time. And I remember covering the twists and turns of that trade war, and it looked like at that point that the Chinese were sort of capitulating to what Donald Trump wanted. But make no mistake of it, that's not going to happen this time around. I think what you see is a Xi Jinping as the leader of China that's far more politically able to withstand the hits that he might have in terms of the political system in China. Economically, of course, it is a much more difficult game for them to play. But on both sides, you have the U.S. being able to some extent, being able to withstand the economic hit from the trade war, and for Xi Jinping being able to withstand the political hit. So you're at a standstill, but there are moments, or should I say, there are points of cooperation and compromise for both the U.S. and China that they could work towards for a longer-term relationship, at least in terms of this trade deal. But I think it is worth remembering that as they go forward with these negotiations, we're going to see more of these twists and turns, more disruption. So I don't think we should be taking this particular moment as the end of the story.
Yeah, every day is a new headline. Karishma, thank you so much. Karishma Vashvani there, our Bloomberg Opinion columnist, joining us out of Singapore. Let's take it back here to Hong Kong, to the Bloomberg Invest conference here. And David is there with our very own Shonali Basak, our global finance correspondent. Let's listen in.
If you look at the front page of the Bloomberg terminal right now, it's full of stories where you see investors who have been overweight U.S. assets and stuck with that reality today. And in the meantime, you've seen U.S. investors that are pouring billions of dollars and raising billions of dollars worth of funds to deploy here. I think that will be a lot of my focus when we come back from the break.
Absolutely. The analogy, I'm just going to think of an analogy there in terms of this, the overweight to U.S. I mean, it's a conversation that keeps happening. It's consistent here in our programming here. You know, to what extent do you lean further away from U.S.? I mean, we all know about home bias, and it's almost like a turtleneck in most people. Like, it's not going to work, but there are people who continue to try it, and it will work for some people, right? So
I'm glad I'm a turtleneck person.
neither am I. But yes, it's does the U.S. equity market merit a 70% overweight given its share of GDP. But that's a whole other can of worms that I guess you'll get into later.
Well, the question is, are dollars moving or is it marginal dollars being spent elsewhere?
That's right.
We're going to let you guys have a networking break. When we come back, we're going to talk to Matthew Michelini of Apollo Global Management, who in recent years moved out here from New York to build the Asia-Pacific practice for Apollo. So a very perfect person to talk to about some of those trends. We'll see you after the break.
Welcome back. Here are some of the top corporate stories that we're following for you today. Losses at Taiwan's top insurers nearly doubled in May as a surging local currency eroded the value of foreign investments. Company filings show 4 of the largest insurers recorded a combined $1.2 billion in losses. The Taiwan dollar's 7% spike added pressure to a sector that already faced $4 billion in FX losses through April this year. General Motors says it's planning to invest $4 billion in its U.S. plants over the next 2 years. It's expanding factories in Michigan, Kansas, and Tennessee. It's also moving the production of several top-selling models from Mexico to the U.S. as it seeks to mitigate an estimated $5 billion exposure to President Trump's tariffs. Citigroup expects to set aside hundreds of millions of dollars more than it did last quarter to account for potential losses on loans. It's an early sign that the biggest U.S. banks may be bracing for worsening economic conditions. The move points to a cautious approach for the months ahead, even as analysts expect loan losses to decline in the second quarter. Bloomberg has learned that Mark Zuckerberg is assembling a team of experts who will be tasked with achieving so-called artificial general intelligence. Sources say he's been frustrated with Meta's shortfalls in AI and has been meeting with researchers and engineers at his home in recent weeks. We're told Zuckerberg aims to hire around 50 people for the new team, recruiting most of them personally. All right, as you can hear, it is getting very loud right now. We're in a lunch break or a little bit of a coffee break right now at Bloomberg Invest. Well, we did hear from Pictet Wealth Management's Hui and Go saying that clients are increasingly looking to Asia as U.S. exceptionalism is seen fading. But Blue Owl's Johan Sander thinks investors should never bet against America. They spoke to us exclusively at the Bloomberg Invest panel here in Hong Kong.
One thing I've learned in 19 years being here in this region and affiliated to Wealth, there's first and foremost always a home bias. That's true probably for every market. But other than the home bias, US is a real large overweight in every client's portfolio. And while we see conversation for clients obviously shifting to Europe, and there are definitely great opportunities, Japan, India, other markets, it's literally impossible whether you are focusing on public markets or private markets to ignore the US. So, and one thing I also learned, never bet against the US and never bet against the US dollar in these 19 years here as well. So there is momentarily arguably shift, and from an asset allocation perspective, I think it makes all sense. But when it comes to scalable solutions, when it comes to finding opportunities, again, like truly scalable, which have an inherent element of protection implemented as well, it's hard to ignore the US in all honesty.
I'm going to ask you both this question too, but I'll make Hui Yang really focus on it first. I think this is one of the harder questions because you have India, you have Japan, there's so many areas with so much promise. Which is the favorite among your clients?
In Asia or just globally?
In Asia.
Well, it really depends on where the client is. You know, if you just look at China, right? Valuation has come off. Is this actually a good opportunity? But for non-Chinese clients, they may think twice because of exit. It's not quite proven. Challenges in navigating that. When you look at India, I think there's a lot of buzz, there's a lot of startup, a lot of innovation, there's a lot of entrepreneurship. But the exits, well, there has been some exits, but I guess it's not quite very well proven as yet. So to be seen, valuation is also quite intimidating. And when you look at Southeast Asia, I think it's really depending on your cup of tea, right? Southeast Asia, some people say that it's not shallow. Some people think that this is a great opportunity because, you know, on the one hand, people talk about deglobalization. What's the opportunity when you have deglobalization? You talk about regionalization, right? So ASEAN is actually a big opportunity as well. But I just want to extend beyond that. So Yvonne talked about U.S. Undeniably, U.S., I think it's a very big economy not to be invested in. A lot of clients are overweight there. So clients, some of the clients, we're seeing that, they're thinking about maybe dialing down because they're so overweight in there, right? So where can you dial it down? Well, if you're comfortable in Asia, there's a lot of opportunities, but it's very fragmented. Again, one needs to be careful because the rule of law is not the same everywhere in Asia. And then you have to deal with foreign currency, right? Do you want to hedge? How do you hedge?
And that was Blue Owl Senior Managing Director Johan Sander and Pictet Wealth Management Head of Alternative Investments Asia, Hui Yang Go there. And for subscribers, you can watch us live and see our past interviews on our interactive TV function, TV Go. You can also dive into any of the securities or Bloomberg functions that we talk about and become part of the conversation. Send us instant messages, questions for our guests as well. Check it out at TV Go.
Welcome back. You're watching The China Show. We're coming to you live from the Bloomberg Invest conference here in Hong Kong. Before we go, just a brief look across the segment or sector to watch today. Rare earths and magnets on the up, really on the back of progress. At least we didn't take a step back as far as trade negotiations go. And I think one of the comments coming through from the conference here is that if we can't have your chips, you can't have our magnets. And hopefully that doesn't remain the case, obviously, as it pertains to progress and, I guess, coming together from quite a wide starting point as well as far as trade negotiations.
Yeah, you kind of have to have both, right? If you're an EV manufacturer or the like. So certainly there is some consensus. I think that's still kind of the theme here today. Equity markets are still doing quite well. Take a look at how the onshore markets are going. We're up about 0.75%, coming off some of the highs already in the session, but certainly you are seeing Hang Seng now come back and match the sort of the gains that we're seeing in the onshore markets. So 188 points on the board. Keep in mind, we're still in bull market territory when it comes to H shares. MSCI China, that reached that milestone yesterday as well. So still, I think there's still some legs to go in this rally in some ways, too.
Yeah, markets have moved on in some ways from being tarrified, I guess is the joke.
Right? Nice word.
Interesting. Let me just end on this. One of the last questions we had from Eric Chatzker in the panel earlier on with Steve Rice and Gene Chia from Stand Chart in back of Singapore. He said, yes or no question. Are U.S. Treasuries still risk-free? They both answered no. No longer risk-free.
Oh, wow.
That should not be the assumption moving forward.
Okay. So, yes, we'll continue to explore those themes of U.S. exceptionalism and the like here, of course. And that is it for us here on The China Show. Insight with us, Lina Ahmed, is next. Stay with us.